Good morning, everyone. I'd like to welcome you to the investment meeting of the Teachers Retirement Board for December 1st, 2022. We'll call the roll. Brian Berge,
representing Mayor Eric Adams, present.
Thomas Brown,
Here, good morning, Ted.
Russell Buckley,
Here for Panel for Education Policy Chair,
Dr. Angel.
Dr. Angela Green, present.
Allison Hirsch,
Here for Controller Graduator.
David Kazansky,
Present.
Deborah Penny.
I am here. Good morning.
Madam Chair and board members, we have a quorum.
Thank you so much, Thad. Good morning, everyone. We are going to start with the Passport Funds third quarter 2022 performance review. And I believe we have Mike Fulvio.
Great. Good morning, everyone. I am going to share my screen, which hopefully folks are able to see.
Well, not feeling well.
Okay, so I was only going to touch upon the quarterly report briefly as this was distributed ahead of time and we did previously review the performance. But just as a reminder for everyone, the third quarter was another market sell-off in both the US and abroad in terms of the equity markets. You can see that show up in the returns here for the Passport funds. The diversified equity fund down about 5.75% for the third quarter. That brought the year-to-date return through 9/30 to negative 26%. The balanced fund did notably better given its 70% allocation to fixed income, though still a negative return at about 3.7%. The international equity fund, as we saw a deeper sell-off in non-US markets, was down about 9.4% for the quarter ahead of its benchmark. And then beyond that, the sustainable equity fund down about 5%, US equity index down about 4.5%, and international equity index fund down about 10.3%. We will touch upon a couple of more detailed items related to this report in the executive agenda under the manager update section.
Thank you, Mike. Does anyone have any questions for Mike? Okay, we certainly hope you feel better, Michael.
Thank you.
Next, we have the Passport Funds October 2022 performance review. Amanda?
Yeah, Mike, are you able to, oh, you did flip it, okay.
Look at that.
There you go. So Mike shared a bit of the negative results for September. Thankfully for October, we did have positive absolute returns really across the board for the Passport funds. For the diversified equity fund, up about 7.2% for the month, which puts it at around negative 20.8% for the year-to-date period. Really both the passive and active components contributed around 8%. Non-US markets were more challenged than US markets during the month of October, particularly China, still struggling from their zero COVID policy there. The balance fund was the worst performer for the month, but still positive, up 1.7%. Some of the bond components of that strategy detracted, down around 12% year to date. And the international equity fund was up around 4% for the month of October, which puts it around negative 25% year to date. And some of the active management there did contribute, beat the index, which returned 3% for the month. The sustainable equity fund was positive 3% for the month, which put it at a negative 30% for the year to date through the end of October. And you can see the passive options at the bottom of the page here, both US and international equities, which were in line with their benchmarks. So all in all, very positive month after quite a few negative months in a row here. So glad to see that, and thankfully that trend has continued here into November as well.
See that, and we really welcome you. So, and I apologize. So we're joined by, so Amanda, your last name? Janice, and Samantha,
Amon.
who are two new or new to our
New to our
new to
relationship.
TRS's account right at Rokutan, so they're representing Rokutan. So welcome. See, and you keep up the good work with giving us all positive numbers. And we're gonna let you stay here.
Mike, when he's on me today, let me do the good numbers, right? So.
That's very nice of you, Michael. Now, let's see what Devin could do. Any questions? Any questions for Amanda before? No? Okay, all right, Devin, no pressure, but we have
No
November
pressure at all.
2022.
I will try to keep the
Performance
theme.
update.
I'll try to keep the theme consistent here. So for the month of November, we expected to have positive results on all fronts. Actually, global market composite benchmark is up positive 6.6%. And fiscal year as well, I would also admit that it's also positive to 7.67%. Diversified equity fund hybrid benchmark is up positive 6.72% for the month and positive 7.76 for the fiscal year. Switching over to the balanced fund benchmark, again, positive 3.25%, positive for the year, for the fiscal year, 1.42%. On the international equity benchmark, international composite benchmark, we see astronomical result compared to the domestic market. We have positive 11.93% and positive for the fiscal year, 3.97, almost 4%. Sustainable equity fund benchmark, we have positive almost 6% for the Brown Advisory Sustainable Growth Fund and 4.56% for the Sustainable Fund Composite benchmark. Moving down to the International Equity Index Fund benchmark, again, 13.49% for the month and 5.14 for the fiscal year today. So overall, the theme has been consistent. We have seen some positive results and we hope that that continues. Although we do want to caution that it may just be a bear market rally, but in any event, we'll take that.
No, now we expect this. Thank you so much. Any questions for Devin? Okay, we're good. Keep up the good work. I don't know, Michael. Looks like you were the only one that did not give us good news, but.
I was the one who fell on my sword for them.
Oh, what a guy.
Yeah.
Okay, so now we're into the public session of the pension fund and we have the quarterly performance review. Steve, you on deck?
Yeah.
Okay.
Thank you, Madam Chair. So one more slide, Kate. So I put together what I thought was a shortened slide deck, and I realized at 4:30 this morning that it's actually a lot longer than I anticipated. I just can't help myself, but I'm going to go through this pretty quickly. Just to give you a quick overview of what's going on in the market and how it's impacting our investments, and then really talk about the performance for the third quarter. So inflation continues to be a problem for the U.S., for the Fed, for the White House. It is at a near 40-year high still. It's come off the boil a little bit. So I think the fourth quarter, more recent numbers are positive in terms of the direction that they're moving. We still see a significant amount of wage price pressures from an employment strength. We also still see a little bit of supply chain bottlenecks associated with lockdowns and COVID protocols in China, as well as energy price shocks associated with the war in Russia and Ukraine. Chair Powell yesterday stated in his prepared testimony that inflation has spread broadly throughout the economy and their test is significant. Next slide, please. In terms of inflation, you can see in the upper right-hand side, it's come off the boil a little bit. It's now under 8% from a CPI perspective. The core PCE deflator in yellow is actually 5.1%. It's been a little stickier. It actually came in this morning at 5% for November, off of a upwardly revised 5.2% in October. So moving in the right direction. Next slide. Inflation certainly isn't just a phenomenon here and a problem here in the States. You can see that red line is the US inflation measured by CPI. Again, coming off the boil, as I said, still a big problem in the UK at 11.1% and in the European Union at 10%. Actually, 10% has come down a little bit from 10.6, but still a problem. There's been some declines in energy prices in Europe very recently that's moved that down a little bit, but still a struggle. Expected inflation, the next slide, Kate. You can see it's come off the expectations around the University of Michigan survey. It's come down a little bit, still pretty sticky, calling for 4.9% inflation expected over the next 12 months. Employment on the next slide. Employment has actually been very robust and has been a little bit of a challenge for the Fed. In the third quarter, early fourth quarter, it was at a 50-year low with 3.5% unemployment. You can see on these headlines that it came in September, 263,000 job growth, 261,000 October. We have a new November employment report tomorrow. The expectations of the consensus estimate is for around 200,000. So we'll see where that winds up, but still a challenge. The next slide. Again, that's just a graphical depiction of what it reflected. 3.7% on the lower right-hand side white. And the participation rate, which is something the Fed certainly focuses on, is still relatively low to where it was pre-pandemic. It's about a point lower. We still have this post-COVID persistent imbalance in our labor market. There are over 4 million more open positions than there are labor force supply. And the Fed hopes to balance the labor market by slowing job growth. And the next slide. The economy actually perked up quite a bit in the third quarter of this year, coming in at 2.6% growth. It was actually revised upwardly yesterday to 2.9% growth. Remember, that's coming off of 2 consecutive quarters of negative GDP growth on the first and second quarter this year. So it is showing some level of resilience. And the fourth quarter so far looks fairly to moderately strong at 3 to 4% expected. So again, economic growth is still powering along. I'd say more on a global perspective. On the next slide, it's still a little bit sluggish relative to where it had been. And again, I just call your attention to the red line. I changed the color of this presentation. That's China. And you can see that they had been an engine for global growth at between 7, 8, 9% growth consistently for many years. And they're continuing to struggle with COVID. And I think the expectation is around 2.5% growth through this year. So still a problem. Growth is somewhat sluggish, but we'll see where we go in 2023. Next slide, some of the factors impacting US growth. You can see that there's been a pretty dramatic historical decline in existing single family home sales. And this actually looks at the period from the Fed's first rate hike to where we are today. And that red lower left-hand line shows that there's been about a 22% decline in single family home sales since they first hiked in March. So again, slowing down in their economy here. Next slide. Housing inflation is expected to come down as well. We have new lease inflation declining, which is the green line, and the expectation for that to continue into 2023. And the owner's equivalent rent looks like it's nearing a peak, and the expectations that should start to level off and perhaps move lower. Next slide. There's also a lot of resiliency and strength among consumers. The U.S. consumer is pretty strong right now. There had been a buildup of that, what's referred to as dry powder of $2.6 trillion. And on the lower right-hand side, you can see that we've been busy as an economy working that off in 2022. It's spending about $620 billion of that reserve. On the next slide, you can see that also corresponds with an increase in credit card and consumer debt, which has moved up pretty significantly, particularly for the lower wage earners. So we are getting back to normal, but I don't know that that's necessarily a healthy sign of increased credit card debt. Next slide, Kate. Global interest rates, the Fed's been very aggressive. They have these supersized rate hikes. They've done 4 now, 4 by 75 basis points, in addition to a 50 and 25 basis point rate hike. It only started in March, so there's been a very aggressive path to raising rates quickly to fight that elevated inflation. Similarly, we've had the same magnitude, or perhaps not the magnitude, but direction of hikes in Europe. There's a meeting of the Fed on the 13th and 14th of this month. The Fed's expected now to increase rates by 50 basis points, but we'll see what the employment report looks like tomorrow and what CPI looks like next week before that happens. December 15th is the next ECB meeting, and the expectations are perhaps for another 75 basis point rate hike. On this slide, and I love this slide, you can see on the far right-hand side the hiking cycle that we've experienced in 2022. Again, it's pretty dramatic and pretty straight up. And you compare that to some of the more recent hikes in, say, 2014 to 16, where the Fed hiked once and was on hold for a year, and then went 25 basis points every other meeting. And if you look at 2003, the early part of 2000s, we had 17 consecutive 25 basis point rate hikes, so much more measured. So this has been pretty extraordinary. On the lower part of that chart, it shows the financial conditions index. It's noteworthy because the financial conditions have actually eased a bit. And that's not really the direction that the Fed wants to go in. And that's dictated by a number of things, the reduction in interest rates with the increase in bond prices, the rallies that we've seen in stocks, and a number of other factors that have kind of come off the boil. What was noteworthy about Chairman Powell's remarks yesterday were that he didn't mention financial conditions, which the market took as a positive sign that he's not pushing back on the recent rally and prices. The next slide, Kate, this is just a different look at that. And again, how fast and furious the Fed's been in raising rates in 2022. Skip ahead, Kate, to 2 pages, please. Credit spreads and US Treasuries. The big news has been more recently in the press is the 2-10 spreads, which typically you'll have a yield premium associated with investing in longer term bonds. So 10-year yields typically and traditionally are much higher than say 2s. That market position is now inverted with 2 years trading around 432 this morning relative to 10s at 360. That yield spread is about negative 72 basis points. It's probably going wider. It had been at an all-time wide in 1981 at 250 basis points. But that tells us a couple of things. It tells us the market, and the bond market in particular, is pricing in a recession in the coming months. That's not really what we're seeing, certainly in the third and fourth quarter. So I think 2023 is going to be a more challenging year for the U.S. economy. Next slide. This just is a depiction of what that looks like. On the left-hand side, you can see the Treasury yield curve. Since we last met, the 1129 figure in the red on the far left-hand side of that left-hand chart, you can see there's been a spike in short rates relative to where we are in, say, longer-term 10, 20, and 30-year bonds. And on the right-hand side, you can see that 2s10 spread widening out. Again, it's rare, and it's about 72 basis points today. The next slide, just a look at credit spreads. Not a lot of news in terms of investment grade spreads have moved up a little bit in the black line. The red line you've seen in high yield spreads have been a little bit more volatile. Right now, I think they're around 435 basis points over comparable maturity treasuries. They've been as wide as 600, and that may be driven by a number of things. The fact that there hasn't been a lot of high yield bond issuance, and there's been both retail and institutional flows into the high yield market as those yields have topped 8 to 10%. Next slide. The dollar continues to be strong, although it's come off the boil a little bit. It's been, I'd say, comparatively good for the U.S. to have slightly stronger dollar because it dampens inflation. We don't import as much inflation. It does serve to make our goods less competitive abroad. And as U.S. corporations repatriate sales and revenue from their activities abroad, it actually hurts those performance and comes down a little bit. As I said, we've seen the dollar weaken a little bit recently. And then the next slide, you can just see some charts. When we last spoke, the US dollar relative to the euro was trading about 97 cents. So each euro bought 97 cents. Today it buys $1.04. The British pound was buying about $1.03 at its bottom, and now buys over $1.20. And finally, US dollar was buying about 150 yen and now buys about 139. So it is a little bit weaker over the course of the last couple weeks and months. On the next slide, I love the first upper left-hand side headline. Bonds may be having the worst year yet. And if you read the content below, it says since at least 1926 and maybe in centuries. Now, the good news is it says most of the damage is behind us, which I suspect is probably correct given the artificially compressed levels that we saw at the early part of the year. We've seen volatility in both stocks and bonds, although that's come off a bit, particularly in stocks. And the bond market rally and stock market rally have increased as expectations for rate hike slowdown has occurred. So on the next slide, again, one of my favorite Bloomberg slides. I was actually meeting with Ed yesterday. We went through this. This is really remarkable. When you look at on the far right-hand side, the yield changes, the basis point yield changes that we've seen across the developed markets and the sovereign debt. So again, US Treasury 10 years moving up about 220 basis points year to date through early this week. It's pretty remarkable. And again, the moves of this magnitude are not typically seen in the bond market. On the next slide, as I mentioned, market volatility. When we last met, it was about 30. The VIX was about 30. On average, over the last 30 years, it's come in at 19, and this morning it was printing around 20. So it's come down quite a bit in equity land. And on the far right-hand side, you can see the iMove index is still elevated as bond prices continue to see a fair bit of volatility, which I think will continue. On the next slide, market returns. On the left-hand side, you can see those are equity market returns, the Russell 3000 in blue, the developed non-US international in gray, and the emerging market equities in red. All of those are down. The Russell 3000 is still down about 18% year to date. Developed ex-US down 23%, and emerging market continues to struggle at just a little below negative 30. On the right-hand side, again, unprecedented, the Barclays Ag, I should say the Bloomberg Ag, as it's been renamed, is down about 16% year to date, again, which is a fairly dramatic move. And you can see over that 10-year period, it is quite unusual. And then the next slide, just a look at a 60-40 split portfolio, underperforming by about 16%. So that balance, that 60-40 portfolio, again, unprecedented in terms of its downside exposure. And lastly, just a couple of headlines of other things that are interesting in the market. On the upper left-hand side, FTX collapse. There's been obviously a lot of issues around crypto, currency sell-offs associated with those assets, bankruptcy filings. So again, that risk asset is not performing very well recently, and I think that will probably continue. Below that, just a sense that we've had 3 British prime ministers in 3 months, which has been an incredible amount of volatility. And then the upper right-hand side, we've seen credit spreads for Credit Suisse widen pretty dramatically. The 5-year credit default swap spreads yesterday were pricing over 400 basis points, which is significant. And we'll see where that goes. Ukraine war continues to impact global growth, and just the human tragedy there as well. And finally, on the lower right-hand side, China is still wrestling with COVID and an increase in unrest associated with the COVID protocols. They may switch or make changes to in the coming weeks and months. The next 2 slides, and then I'll get into the performance. Just food for thought. Again, there is no predictive value here, but this is a chart of the VIX recently overlaid with the VIX back in 2006 to 2009. And they look like they pretty closely mirror one another. Again, no predictive value, but I think it's just interesting to look at where the VIX is relative to where it's been prior to the market sell-off. I think perhaps even more interesting is the next slide. And again, I have to caveat this, no predictive value, but this actually looks at the S&P charted relative to the S&P back in 2006 to 9. And again, you can look where it kind of starts to really drop off in the green. That's post or during the Lehman default crisis in September 2008. Again, no predictive value, but just things to think about. I think the U.S. economy and the markets have experienced certainly a rate shock. I think there's an earnings shock coming associated with the rate rise and potential liquidity shock. So again, no predictive value, but my expectation, I wouldn't be surprised to see increased volatility in the first half of 2023. And on that happy note, maybe move to the public market returns on slide 32, Kate. Again, it's been a tough year, tough quarter, and a tougher year. You can see those are the various benchmarks that are down pretty substantially in the third quarter and certainly for the year. So yeah, it's been a challenging year to say the least. The expected returns on the far right-hand side are actually an average of the 5 generalist consultants across the 5 public pension plans. But again, those expected returns are over a 10-year period. That's more informational value. I don't think that's a fair comparison to where we are in 5 years and certainly not 1 year. On the next slide, this is actually a look at the teacher's performance relative to strategy. And again, tough quarter, tough year, with the exception of cash, which unfortunately we have a 0 official allocation or targeted allocation to, but we do have some element of cash to meet capital calls and distributions. But it's been a challenging year. I think the more important thing the focus is on, however, is notwithstanding the pain that we've seen recently, is the 5-year outcomes are actually still pretty strong. And you know, you have to look at the significant drawdown in asset prices in 2022. Again, it's having, because they've been so substantial, it's weighing down on the 3 and 5 year returns as well. On the next slide, to speak a little more positive, these are the private market returns by strategy. And you can see that they've held up well, certainly in 1 year, all in the plus zone, although they've come down a little bit. And these are as of marks and performance through June 30th of this year, with the exception of OFI, which is mostly through September 30th. I think most importantly, you look at the 10-year performance since inception, and the performance has been quite solid. And I think that the private markets have been a good source of diversification and balance for the portfolio year to date. Teachers' total plan assets in terms of return, 3 months negative 4.7% for the third quarter, and 1 year down 14%. Again, a challenging year and a challenging environment. However, it is outperforming its policy return, again, which uses public market proxies for private assets, which kind of skews things a little bit. But again, in line with what we'd expect given what's gone on in the general market. On the next slide, Kate, just a look at the performance. So the good news is the excess return is about 97 basis points. That's largely driven by investment manager selection on the far right-hand side of 106 basis points. On the next slide, just a look at the public market excess returns. Again, it's been a challenging year, but there is some glimmer of light here. In 3 months, we've seen slight outperformance in emerging market equities and core fixed income, as well as our ETI mandate, which is relatively small on a comparative basis. But again, I try to focus more on the 5 year excess returns, what we've done on a longer time horizon, which is a bit more positive. Obviously, the thing that stands out to me in this slide is the 1 year excess returns in the World ex-US and emerging markets, down 561 basis points and 252 basis points respectively. It's been a tough year in those particular strategies. And I know that John Mercerberg is here, can certainly answer questions on how that's occurred and where we think this goes over time. And one more slide, private market excess returns, a much more positive story, certainly for 1 year, 3 years, 5 years and since inception, with the one caveat or the one exception of the private real estate non-core or opportunistic at negative 760 basis points. That is largely due to the fact that a lot of the recent investments are still in that J-curve period where they're subject to capital calls but not distributions. There's also a little bit of a drag associated with the multifamily exposure in New York City housing with rent freezes, rent control and rent freezes that kind of hurt some of the valuations of the underlying holdings. Also, the fact that Teachers was investing in real estate ahead of and into and through the global financial crisis has been a little bit of a drag. And finally, the hotels, we've had some COVID exposure that have hurt hotels and retail space that's reflected in that one area of underperformance. I did go through this with John Glusak, our asset class head of real estate yesterday, and he actually gave me a couple interesting statistics that I wanted to share. So if you look at the performance from the vintage 2002 through 2010 real estate investments in core and non-core, they're up about 8.5%, generating 8.5% annual return. And from 2011 through 2018, again, outside of that J curve, they've produced returns of 14.5%. And relative to its public market equivalent benchmark, it's about 500 basis points over. So it's a good story, not a great story, but a very good story in terms of where we are more recently. And one more slide. Actually, I think 2 more slides. Just to look at a rebalancing, Kate. Yeah, thanks. We have John Mercerberg here. I went through him with him yesterday. Most of the rebalancing was really to adjust our equity capital market weightings, as well as to move from the Russell 1000 to the Russell top 200. But nothing dramatic or unusual about those changes. And last slide, Kate. Just to look at our under and overweights. And again, we traditionally have been overweight cash because we have a zero targeted allocation. And other than that, we're pretty much in line with every strategy and every underlying asset class. any questions? I know I've kind of gone through this quickly. Brian?
So that was pretty dire macroeconomically overall. And my reaction is to try to find glimmers of hope, and I need you to defeat that reaction of mine. Is it wrong to view recent yield curve movements and the weakening of the currency relative to other countries also experiencing inflation as a market indicator of reduced future inflation in the United States? Which, I mean, that seems to be driving everything these days, like what inflation is likely to be.
I think so. It's also perception. So we had the Fed Chair Powell yesterday gave some very interesting remarks. And what was interesting is it does look as though that the Fed is in a position where he talked about the pace of rate hikes is likely to moderate as early as December. And the market took that to mean that instead of a 75 basis point rate hike, there's probably going to be a 50 basis point rate hike, which is priced in. And then after that, it's more fair game. Right? I don't know if that answers your question, but the idea that we're starting to see the proper move down in inflation here. And again, monetary policy acts with a very variable and long-term lag. So the Fed, I think, is being rightly cautious. Having said that, I didn't see or read anything in the commentary yesterday that made me think that the chairman was being dovish at all. In fact, he talked about having to get to a higher level than had been previously anticipated in their forecasts of economic expectations in September. We'll get revisions on the 14th of December, as well as that 50 basis point rate hike probably. But the prior expectation meant about 4.6% in terminal Fed funds rate. He's saying it's significantly higher, which indicates 5 to 5.25. He also has been very clear the need for the Fed to leave rates at an elevated level for a prolonged period of time. So again, it's hard to be optimistic when you think that the economy is going to slow at some point. It may, and again, if the bond market's correct, it may precipitate a recession at some point, which have an impact on earnings. So I look at what the market reaction yesterday with the NASDAQ up over 4%, and I think it's just early. And I think that the market wants to rally. Some of it may be more technically driven, but my expectations are, my gut tells me that 2023 is going to be a little bit more challenging, certainly in the first half of the year. And as we get past the Feds, I think the Fed will be done hiking rates by perhaps the first quarter, depending upon the data, and then see where that goes, the impact on earnings. The multiples have come down and compressed. I'm more optimistic if that's a better way to answer the question for the second half of next year.
So just to follow up, so it sounds like your view is maybe on the bearish side of things, at least in the short term. Does that at all inform the activities that FAM will undertake in the short term, or is that just something that, do you take action on? We do
at the margin. So that's a great question, Brian. So we have an asset allocation that's been given to us by the trustees that we adhere to. We're meant not to be nimble for a reason. We're supposed to be long-term investors. We're not supposed to overreact to headlines. Although now that I say that, I use the headlines as presentation fodder, but we're supposed to be stable and consistent investors. But at the margin, I'll give you an example of one of the deals we looked at for OFI, Torchlight, which we really like a lot. And it's one of the reasons why I particularly prefer them is because they're relatively defensive. And when they came and presented to us, they talked about what they're doing with their portfolio, that they're investing in higher credit quality, shorter maturities, higher in the cap structure. Relative to another deal we looked at, and we went through green light, and at the investment committee, we opted not to go forward with it because we thought they used too much leverage and it was just too aggressive for the environment. So yeah, at the deal level and at the investment manager level, we're less aggressive.
Okay, thank you very much.
Any other questions for Steve? Okay, hearing none, do I hear a motion to go into executive session?
So moved.
Thank you, Mr. Brown. Do I have a second?
Second.
Thank you, Mr. Kazansky. All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? Okay, we're going into executive session. Back into public session. Ms. Stan, would you like to report out, please?
Certainly. In executive session, we received some preliminary performance data. We received implementation plans for 2 asset classes. Consensus was reached on both. We discussed and received a presentation about an investment policy issue. We received presentations on 3 private equity deals. Consensus was reached on 1.
Thank you so much. Does anyone have anything else for public session? Okay, and hearing that, do I hear a motion to adjourn?
So moved.
Thank you, Mr. Kazansky. Do I have a second?
Second.
Ooh, it's a tie. I don't know. Okay, definitely have a second. Any questions? All those in favor of adjourning, please say aye.
Aye.
Any opposed? Okay, we stand adjourned. Thank you.